Is the real estate market going to crash? Everybody's talking about the upcoming crash, the upcoming housing crash, that we're in for a world of hurt. Is that true? Does the data show otherwise? How do we make a decision if we don't really know what's going to come? What do we do in the meantime in our real estate investing, and if we're going to buy a personal home? Well, let's find out. Hey there, my name is Mike Fritz. I'm the founder of Titanium Capital Investments and Power Up Real Estate. On this channel, our greatest passion is to help you build businesses, invest in real estate, and create the life of your dreams. The truth of the matter is, when you're looking to buy real estate, whether you're investing or buying a home, you want to make sure you look at what's going on in the economy to make the best decision. So many people have said a crash is coming, but is that really true? Also, make sure you smash that thumbs up button. I mean, absolutely obliterate that sucker. Also, make sure you subscribe to the channel, join our family of business owners and real estate investors. Turn on that bell notification so you get notified every time we do a video. We want to keep giving content to your life so you can make wise decisions in your investing and change the entire trajectory for generations. So make sure you stick around, smash that thumbs up button, and subscribe. So is the real estate market going to crash? Are we headed for the crash everybody says there is? The first thing you have to understand is what actually causes a real estate crash. The biggest thing that causes a real estate crash is supply demand. It's the #1 driver of all crashes. In fact, it's really the only reason anything ever crashes. So it's when you have too much of something and not enough desire for it. That causes it to go down. So when Apple stocks are going up, it's because more and more people want the Apple product. It's the same thing. If less and less people want the Apple product, what do you think is going to happen? We're going to see a decline in Apple stocks. If there's perception in the marketplace, I don't know about what's going to go on with Apple, and people kind of pause, it starts to go down. It's the same thing with real estate. Supply demand. When there are loads of houses and not a lot of buyers, those houses, what happens? The prices come down. But when there's only a few homes and there's tons of buyers, what happens? It drives the cost of those homes that are on the market in a massive northeast trajectory. So think about when the pandemic hit in 2020, early 2020, housing was we were in a good real estate place. It was pretty normal. Going really well, good growth trajectory. Well, when the pandemic hit, everyone paused. People didn't want to sell their homes. Actually, it happened because a lot of people didn't want a lot of people walking through their homes as they were nervous with the virus. They didn't want people walking through their homes, so they paused. Well, what that did to the homes that were on the market is it shot the price northeast. Well, then, as COVID started moving people around the country, then certain regions saw depression and certain regions saw appreciation. So you have a lot of California people moving to inland cities, Boise, Denver, Salt Lake, Phoenix, all these cities that are inland. We saw a massive move from California inland. Well, California saw a little bit of a dip there, and a lot of our places, I live in Phoenix, Arizona, our homes skyrocketed more than any other city in the country. And it's because, again, we had a supply-demand surplus, meaning we had more buyers, and more buyers, and we didn't really have any more homes. At one point in Denver, Colorado, there was 832 listings, and there's 14,000 real estate agents. Do the math. The idea is that there's only a few homes for a big amount of people. That drives the price of those homes up. You all know if there's one single thing, how much is that one single thing worth in the world? Think about the Mona Lisa. If you think about the Mona Lisa, think about how much the Mona Lisa is worth. There's only one of them. There's not a Xerox of the Mona Lisa. There's one. So it's worth so much money. It's same with real estate. When there's only a few, the price of those few are higher. So you have to understand when you step back and look at economic turbulence, what causes it? It's a supply-demand issue. Now you have to start asking the question, what shifts some demand and supply? What adds more supply to the market? What shrinks demand? What adds demand? Right? So that's the kind of question we have to ask. The question isn't, is the market going to crash? It's what things are in play that can play with this supply-demand relationship. When we ask about the supply-demand relationship, now we're actually asking about the right question, because that's what will dictate whether the real estate market goes down or not. It has nothing to do with the economy. It has everything to do with supply demand. Now, economy is one of the things that hits supply demand, so we have to look at that, but we're asking the wrong question. Is the real estate market going to crash? It's Are the things going on going to shrink supply and skyrocket demand, or is it going to shrink demand and skyrocket supply? That's what causes a real estate to crash. For example, rewind back to 2008, 2009. What caused that crash? In 2006 and 7, we had a lot of people coming into loans that were not very favorable to the consumer. They were favorable when they started, when they got that 50-year loans that were going out at 0% down, got their payment really low. But it was, many of them were ARM loans, or adjustable rate mortgages. So when that adjustment rate was up and it skyrocketed, all of a sudden they couldn't afford their home. So all of this supply came to the market. So when all this supply came to the market and we didn't have any more demand coming with it, what happens? Boom, we see a crash. Again, supply demand. So right now, what is going to shrink supply and what is going to shrink demand? Well, people will say, rising interest rates, Mike. Interest rates are going up, so therefore supply's got to shrink, right? Or demand's got to shrink, right? Not necessarily. The data's not in that rising interest rates stops people from buying homes. They just make sure they can afford it. They may buy less of a home. Instead of an $800,000 home, they might buy a $700,000 home. Instead of a $300,000 home, they might buy a $230,000 home or $50,000. But it doesn't change if they buy. It just changes what they buy. So you have to understand the difference there. Again, supply, demand. So what does change that? The number one thing, of course, as I just mentioned, is interest rates. Interest rates can change supply, demand in people's minds. But it doesn't actually in actuality. So when you get out in the market, it's not really messing with it. So the number one thing that actually changes supply demand is foreclosures. So when people foreclose on home, it thrusts a bunch of inventory into the market. Now, right now, there are so many investors and so many buyers and so many people begging for inventory. It would take a lot of homes to the market to even come to even normalize the market. It would take a ton. So understand the housing market is very isolated right now because the demand is so far ahead of supply. We have to have a massive shift to equalize that. Now, that can be equalized over time, right? That can be equalized, and sometimes it can happen very shortly. 2008, 2009, it didn't take very long for that supply demand to flip on its head. So it can change it over time. The second thing it can do, not only rising interest rates, but if it's hard to get loans. And this is what made it hard to get the 2008, 2009 market back on its feet for years, is when the banks did crash, and they were the cause of the great crash in 08, 09, then they tightened down on restrictions and made it so you could only get loans with 20% down. Well, there aren't a lot of people that have 20% down in the bank, especially after that crash. So you have people that want to buy a $200,000 home now have to have a $40,000 pile in the bank. Not a lot of people have that sitting around, at least at that time. And so you have to understand when it's hard to get money, that can shrink the loans as well. The third thing, and one of the most important things that impacts supply demand, is employment. When employment numbers are going down, it really changes the buying power of people. When employment's going down, therefore wages are going down, people are out of work, they're on unemployment, they ain't thinking about a home, they're thinking about survival. And so they're thinking about making sure, can I make sure I pay my bills? Can I make sure I have enough money for just food, water, and shelter, clothing, just the necessities, right? So again, employment change. Now, right now, one of the things we have in America, especially in the United States, is our employment is strong. Businesses are growing. It's amazing. I mean, this is a great economic time, especially for business owners. So with employment staying strong, it's going to change the way real estate responds to that. It's going to respond differently. And I'm going to tell you at the end how I think the crash is going to happen. So stick around to the end. The crash is going to happen, but it's going to happen different than it's happened a long time. And it hasn't really happened like this before. So make sure you stick around. I'll walk you through how I think it's going to happen. The two fundamental changes in our market we see are rising interest rates and inflation. Now, rising interest rates don't necessarily change home buying, but it does change perception in some people's minds. So some people may stop investing or stop buying, but what we've seen over time with the data is the trajectory is still northeast. It might take a little bit of dip, but the trajectory is continued northeast. But that's one economic fundamental change, and the second one is inflation. We see inflation going up, and it takes more of people's dollars to buy the same amount of stuff. So if wages don't keep up with inflation, then we're going to see a problem, especially in the middle class and lower middle class. It's where it's going to hit it the hardest. So if wages don't go up with inflation, then we're going to see people have less money to invest or less money to buy homes. So that is going to shrink demand. But again, will it shrink it enough to catch up with that supply that we already, or to catch up with the demand we already have and equalize that supply-demand relationship? The third thing I want to make a distinction from is buying a home for personal use and investing in real estate. So is the housing market going to crash? A lot of times you have to ask the question, do you mean the same thing as the investing market? So like, is real estate investments going to crash with the housing market? Right? And so when the real estate crashes, all real estate crashes, but you have to understand when we own investment properties, we're owning cash producing assets and we're owning things that people need. People need places to live. And in economic turbulence, if people do lose their homes, what do they become? They become renters. And what do we have? We have rentals, whether it be multifamily or whether it be, storage units is great in times like that, or multifamily or even single family homes. And so the idea is that when we own investment properties, even if the interest rates have gone up and we're ready for a crash, as long as you own something that's producing cash, you're going to be safe. Your value may go down. You may own a $400,000 duplex that goes down to $230 or down to $180 and it just tanks, but your rent stays the same. Sometimes your rent even goes up. And so as your rent continues to go up, you're still making money. It's still a valuable asset. So even though you owe more money on it, you're making money on it. You're earning money. So you can just hold that until the real estate market comes back up. So again, are we headed for a crash? We're headed for a different kind of crash, but you have to understand how the economy works, the fundamental differences in our economy right now, and are we talking about buying a personal home or an investment? Now, if you're talking about buying a personal home, yes, housing prices are rising and they most likely will turn and start to come down. But housing prices with where they are coming down is not a crash. That's called normalization. There's a difference between normalization and a crash. 0809, crash. Normalization was like 2018 and a half, middle of 2018, where prices just came down a little bit and it just kind of started to even keel until COVID hit, right? And so that's we need some normalization in the market, quite frankly. And so that's a powerful thing to have. So understand normalization, having it coming down does not mean a crash. It could just be coming down to where you're not getting 5 offers in 2 days. You put your house on the market and you sell it within 30 and get a couple offers that you like and then you move on, right? It goes back to the normal housing market that we've seen, the healthy market in 2017, 18, 19 that we saw over a 3, 4, 5 year span there. So understand, not a crash, but normalization. But there's a difference of how the crash is going to interrupt the market. So if you're going to buy a personal home, your own personal home, I'd buy it immediately. The interest rates are going up. So lock that home in immediately as fast as you can. Get a home so you get the interest rate as low as possible. Make sure you can afford it. Don't overspend past your finish line. I'm telling you, that's a dumb thing to do in any economy, right? So if you're going to buy a personal home, buy it immediately. But understand what rising interest rates mean. So in 2020, when interest rates, my wife and I bought our home in 2020, and our interest rate was 2.87%, really, really low. Now it's about 4.5%. So if you come up to 4%, so from 2.5%, let's just say to 5% interest, that's usually what we paid at 2.87 to a 5%. That a $500,000 home, 2.8% interest, about $2,000 a month, just over $2,000 a month. That same home at 5% is going to be about $2,380, almost $2,400 a month. So you're looking at about a 14 to 18% increase, depending on the your bank structure and how much money you're putting down. It's going to be anywhere from a 14 to 18% increase of monthly payment when you're looking at a interest rate going from 2.5 to 5. So if you're buying a personal home, do it immediately, but also adjust the size of house you buy to absorb that raising interest rate so you don't feel that in your financial picture. And if you're going to invest, just don't stop. Just change your strategy. You never stop investing. Come on. You don't wait to buy real estate. You buy real estate and wait always, right? So we just change our strategy. So interest rates are going up. We just look at the price and make sure we can absorb that with either rising rents or absorb that with either a little bit better price. Make sure it makes sense. Don't overextend yourself. Don't make it so, you need every single unit rented every single time, every single month with no hiccups to make money. Don't do that. That's a stupid way to invest always. But again, will the housing market crash? The answer is, I believe we will see regional recession, not national recession. I think certain cities, especially big metro, where we're seeing big metro at being a very high level to live, a lot of money to live. This is what you saw in COVID. You saw people running away from metro to more cost-effective places to live. New York City flooded down the coast to the Carolinas and Georgia. California flooded over to Boise and Denver and Salt Lake and Phoenix. More affordable places to live. So I think those big metros are going to take a hit because people are moving to more cost-effective areas. But I don't think we're going to see a national crash unless something happens that thrusts enough supply into the market that levels out demand. And will that happen? Eventually, it always has to correct itself. The only way to have a healthy real estate market is to have that up and down. So a crash doesn't scare me. It just means we change our strategy. I also want to give a free gift to you. We have our 7 secrets for building wealth and managing money. If you'd like that free ebook, go ahead and click that link in the description, snag your free copy so that you can start reading through and understanding more ways to maximize your dollar in your life so you can create the life you want. And as always, watch our videos. We put a lot of great content on here to help you build your life. Watch more videos, and I'll see you in the next one.